Hey guys, welcome back to the channel. This is Future Trading with Mike, and today is September the 7th, okay? Great topic at hand today that I want to talk about, and that is identifying market reversals simply using supply and demand zones, okay? And this all can be done within a matter of a second. So let's go ahead, jump into today's video, and get rocking and rolling. Now, first and foremost, let's talk about what supply and demand is, okay? Supply and demand is simply aggressive buying or aggressive selling in the market, okay? That's pretty much all it is. It's areas where you see a lot of buying come out of a certain zone, certain swing or whatever the case is, and then, or supply where you see a lot of selling coming out of. So supply and demand is simply just that. Now, market reversals, what are they? Market reversals are areas in the market where we see the market changing the tide, okay? The market is changing its actual direction, okay? That means that the market could be making lower lows and lower highs, moving to the downside, breaking through structure, and then at some point, it hits an area of demand, okay? And when it hits an area of demand, it shifts, okay? Starts pushing up and starts breaking structure back to the upside, okay? And that is what's called a market reversal. It's an area where the market pulls back to, all right, where there's a significant area of buying or selling, okay, pulling back to. It can pull back to an area of supply. It can pull back to an area of demand, either or, okay. Once it gets to an area, okay, an area like that where a lot of buying or selling came out of, you have to wait and see if the market is going to reject that area. Once it rejects that area, if it rejects that area, okay, and then clearly, if we're at an area of demand, price hits an area of demand, boom, blockade there, starts to push up, starts to break structure to the upside, okay, meaning breaking through an area of resistance, okay, then that should give you a signal that the market is actually changing direction, okay, and that's called a market reversal. And then it's the opposite if the market was actually, pulling back or, basically pulling back to an area of supply, okay, pulling back to an area of actually an area of supply. Then what we want to see is, all right, is the market going to shift? Is it going to start pushing to the downside, pretty much, meaning that start to break structure to the downside, pull back, and then we see the tide change, okay? Market reversing there too. So today we're going to talk about spotting those market reversals in the market. I'm going to show you some examples simply using supply and demand, okay, in our trading, all right? Now let's look at and spot an area of market reversal off the 60 range chart, okay, the 60 range chart, all right? The market is making clearly higher highs and higher lows, pushing to the upside, okay? And as it's doing that, what is it doing? It's creating areas of demand in the market, okay? It's breaking structure to the upside, pulling back, breaking through resistance, and pushing higher. Then we see the market at some point up here, at this price level here, turns, it pivots, it changes direction back to the downside, okay? Meaning it starts to break structure, coming back down. And everything below it, as prices moving lower, these are considered areas of demand. Areas where there's aggressive buying, okay? Aggressive buying that took place in the market, meaning buyers were putting on positions to push the market higher. And as retail traders, we want to trade like the bigger players in the market, okay? Because in trading those areas where the market started pushing higher, okay? Where the buy-in started at, okay? We don't want to be halfway into a move, okay? So, in spotting the market reversals, okay, this is what you do. You simply look for areas where the market pulls back to, which can be considered an area of demand, okay? We're talking about pairing, looking at supply and demand and how to find or identify market reversals. So, the market pulls back. Here's a clear example. It pulls back right here, okay? All right? This is an area of demand sitting or resting right here on the 60 range chart, okay? This is a trading zone. This is a demand zone right here. The market pulls back to this area. What do we see? All right? The market rejects this area here. It pushes up. And what we're looking for is for the market to do what? To start to take out, say for instance, resistance right here, a level, I call it a breaking structure. Price pushes up, pulls back, breaks higher, it's taking out a structure right here, okay? So, it's pulled back to an area of demand. It breaks through structure on its way to the upside, pulls back, Now, that is what we classify a market reversal. The market pulling back to a key identified demand zone, rejects it, meaning it does not push through it, closing below this low, okay? Starts to reject here, pushes higher, and it starts to take structure back out to the upside. And from there, all you do is simply sit back, wait for pullbacks back to new areas of demand that price pulls back to, and take your trades going along. Okay? So where the market was once pushing up, it turned around and started pushing down, tapping into an area of demand, rejecting it, now starting to break back through structure that it made on the way to the downside. Okay? Breaking structure, pull back to a new area of demand, and you simply go long. This is what's classified as a market reversal in the market, simply with price tapping into an area of demand. Okay, now we'll look to see, if we use supply, if we can identify an area or zone considering an area of supply, and see if we can identify a area of market reversal. All right, now here is a classified or example of how we classify supply. Okay, now supply, here we go. Well, I just said price was making these higher highs and higher lows, right? Then it turns direction and does what? Starts making lower lows and lower highs, okay? So what's happening? It's taking out structure. It's taking out areas of support right here on the left side of our chart. And as it's taking out these areas of support as price pushes down to the downside, okay, what is it doing? It's leaving behind key areas of supply, okay? Talking about supply and demand, guys, okay? And looking for what? Those market reversals, all right? So it's leaving behind key areas of supply. It's breaking structure as it pushes to the downside. All right. So price starts to push higher. We've noticed that area of demand sitting right there. It rejected this area, broke structure, and started pushing higher. Basically, this is a pullback, and it starts tapping into areas of, pretty much areas of supply above. Okay. All right. So price pulls back, comes to this area right here. This area here is where price broke structure right here to the downside. It pulls back pretty much to that area right there. Okay. So basically what you have is is price setting up for a new area of supply in a sense, because it pulls back to an area pretty much of, some people will call it resistance. But it pulled back, rejected this area right here. Okay. And what does it do? It pushes down, breaking through new area of structure right here, the same area of structure where price was making these higher highs and higher lows, pushes down, breaks through structure here. All right. When it starts to break structure as it pushes lower after rejecting this area right here on the pullback, so price basically did this. Let me show you. Pull back. Okay. All right. So we have an area, price pull back, rejects. Okay. Delete it. Okay. Rejects, pushes lower, breaks structure here. We have now an area of new supply area here. Pulls back to it. The moment pretty much price pulls back to that area, rejects it, you can actually go short. Okay. All right. Because the market has changed tide. Okay. The market reversal. This is classified as what is known as a market reversal. Okay. Price breaking areas of new structure. Okay. After pulling back to a key area. Okay. So price was breaking structure to the downside, pulls back, okay? Pulls back here, all right, to an area that it rejects, breaks lower, makes supply, okay, right here, and this is what's classified as a market reversal. Now the market does what? Starts to push to the downside. The supply area is right here. This is the zone where supply can be marked off at, is right here. Let's mark it right here. Price pulls back to it. Short, okay? Now this is the higher time frame chart. So basically what I like to do is I like to scale down to a lower time frame chart, like a 12 range chart, to see if, to kind of not classify, but to identify more so rejection, okay? I really want to see if price is really rejecting that area. So, but I'm using my 60 range chart. I primarily marked significant areas of supply or demand off my 60 range chart, okay? Now, if we look back up here at the tops, okay, now here's another area where the market started to was reversing. As it was making this, these higher highs and higher lows to the upside here, way out to the left-hand side of the chart, I guess if we really look out there, there's some area of either resistance or it's tapping into some area of supply, okay? Now, here it is. The market tops right here, okay? We have all the structure below us, okay? Starts to break down, pull back, make it a lower high, break lower, and starts to break structure here. Now we have a classified area or a area of supply sitting right here, okay? And what happens? Price pulls back to it, all right? And the moment price breaks down, pretty much, this is the higher time frame chart, okay? So I actually scale down to my lower time frame charts to really identify the area of rejection, okay, before I jump into a trade. But you could trade this off of a 12 range chart by basically looking for a candle break. So let's just, if this was a 12 range chart, say for instance, and we saw this setup right here, I would be looking for a candle break primarily. So candle break would be meaning that I want to see a red candle close to the downside, breaking below the last up candle, okay? Last candle that closed to the upside, okay? So, which would be this candle right here, and you can go short at the end, or once this candle here closes red to the downside, back down to the lows, and then you see that will follow suit after that. So if you got into a trade here, say for instance, if this is the 12 range chart, 42.80, take it on down to the lows down here, you can easily pick up, 20 points or so, or even more if you held the trade out, especially if you saw price pullback, okay? If you had stop loss, or you at this point probably break even, whatever case is, you may possibly want to stay into the trade and ride it on down. But it's kind of tough sometimes when the market's pulling back, because you never know what the market's going to actually do. Is if it's going to turn back around and continue back to the upside. But clear identifier here was kind of price broke structure here, and after making this lower low here and break it down to the downside, you could almost bet the price was going to continue on the pullback, when it pulled back right here, to make a lower high and continue pushing lower. So yes, this was a pullback. So when the area of supply, this is classified as a market reversal right here, and you go short, okay? So I've shown you two examples of supply and one example of trading, market reversals using demand, okay? Now let's look to see if we can spot maybe some, actually using the 12 range chart to identify market reversal. Simply, surrounding those supply and demand zones, okay? And how we actually trade it, okay? So this is using the 12 range chart, all right? We saw price, we see price here. What is it doing? Making lower lows and lower highs to the downside, all right? What does it do then? It must have hit some area. If we look to the left-hand side of the chart, okay, down here, this is an area of demand right here, okay? Back from September the 1st, okay? So it hit some area of demand, all right, to the left side of the chart there. That's demand. Price rejects. What does it do? It starts to break structure back to the upside, meaning taking out swings, taking out structure. Pushes up, pulls back, breaks higher, takes out structure. And it continues breaking structure to the upside, meaning breaking through new areas of resistance that it's creating as it's pulling back, and it continues pushing higher. Now, as price continues pushing higher, it hits this area right here, okay? It taps into an area of supply right here, okay? All right, price push down, pull back, push lower, creates an area of supply right here. So basically when price retraces on its move back to the upside after hitting an area of demand down here, it taps into an area of supply, okay? But here's the thing. You can possibly trade this area of supply back to the downside, or you can look to take a pullback here to this area of demand sitting right here, okay? I'll probably wait for the pullback to this area of demand. Why? Because price had already bounced previous to off an area of demand over here and started to break structure back to the upside here, meaning it started to break through resistance, break it up, and basically making what's called continuation areas of demand as it continued to push higher. So when price pulls back right here, all right, price pulls back right here to this area of demand. It's an untested area of demand, all right? And the way you trade it is just wait for a candle break, meaning price to break the last red candle as it pulled back to the downside. This red candle right here, price breaks back above it, go long and take it long, at least back up to the high right here, or to the next area or the next high that is pretty much above this area here. So this is the most current high, or most recent high, okay? Because the price pulled back, most recent high, okay? Price rejects it right here, close that green candle there, go long, take it back up to the high, and try to stay into the trade to the next high, okay, which would be right here or somewhere up here, okay? So basically at that point, what you're doing is you're just trailing behind price. So that's pretty much how you do it, guys. That's how you trade, you know, market reversals. That's how you trade market reversals, simply using supply and demand zones. I hope that was beneficial. I hope you guys found some value in today's video, and maybe now you can actually spot those areas yourself. And it doesn't take much time, guys. It's a matter of a few seconds. You can catch them and you can get into those trades pretty quick. Appreciate you guys watching today's video. If you're interested in joining the Discord, guys, there we do have a great community to where, you know, fellow like-minded traders like ourselves who are future traders come together collectively each day in the market. And I'm going to show you guys the Discord right quick. So if you're interested in joining, I'll pull it up right here. Each morning, I think we have about 270 members now, maybe a little more, I'm not quite sure. But each morning we come together collectively as, you know, as future traders, and we talk about the markets, okay? We talk about, you know, our levels of interest, zones that we're interested in trading, strategies that some of us use, whatever the case is, just various topics at hand. But we pretty much come together to help each other out each morning into the session. As the session's going on, people are trading live, we help one another out. As we also use it, the community as the Discord community as a forum for questions and answers. So maybe you have a question and you're looking for an answer. Put it out there on the community, out on the Discord. So if you're interested in joining the Discord, please find the link down in the description portion of this video below. And join the Discord. It's free of charge. Click on the link, invite yourself in, and become part of the community today. Outside of that, that's all I have. See you guys in the next video. If you're trading today, please be safe, and I'll see you in the next one. Goodbye.